We're here with David Nelson of Nelson Corp Wealth Management. Great to see you again, as always, David.
Thank you, Jim. Appreciate it.
We've talked a lot in the past about owning stocks and the risks and rewards associated with that. Can you take us behind the scenes a little bit? What goes into driving those returns that investors want to see?
Yeah, so it basically boils down to three different items, and I think we'll have the slide up here. First of which is, I think, probably the most obvious, and that is the dividend. So most stocks will pay a dividend, and so again, that's fairly predictable as far as that you're going to get as far as on an ongoing basis. Number two is going to be the earnings per share. Earnings per share is looking at the growth as far as that you're going to get as far as on the shares, and then the final one is the change in value. So the valuation, this is more of a sentiment type indicator, and if you put the three of those together, you come up with what we call the total return, and that's really key. That's what people are interested in. You know, how much did I make as far as on my investments overall, and that's the dividend and everything combined.
When you look at the actual returns, how do these components work together to come up with that number?
Yeah, it's an excellent point as well. So slide 2, I think will show a nice visual here over a period of time. I'll start on the right here, and we're looking at 1926 to 2018, and what we find is that the red is the dividend and the blue is going to be the earnings. Those are the biggest components as far as that come into play, and the market has averaged 9.9% since 1926 to current. What's interesting and what we try to pull together here is that every decade we see a pretty dramatic difference as far as returns as we go along here. We go back to the Great Depression, negative rates of return, negative 1% for the decade of 1999 through 2009. These are very dramatic differences as far as what takes place again, and it's all basically coming back to how are we making the money? Is it coming in the form of dividend, growth, or is it going to come in the form of PE change as far as during that particular period?
Certainly useful information. How can people at home apply this for themselves if they want to invest?
This is the key. And again, this type of information, when individuals are thinking about tomorrow's, I think probably one of the most crucial things in the patterns that we see as far as on here is that when you have a good decade, you generally are going to follow it up with a bad decade. So what we want is we don't want heroes at this point in time. We've had a really good run here over the last decade, a little over a decade, and we don't want to give that money back. So the predictable part is the dividend for most companies. The other is going to be very subjective. And again, I think the rule of thumb is to look in the rearview mirror as far as what's taken place. That's generally a pretty good indicator as far as looking forward as far as what's going to take place. And it's this effect. It's not going to be, it's been great, so it'll continue to be great. Generally speaking, if you have a good decade, you're going to follow up the following decade, not so good.
Managing those cycles always the key.
Exactly, very important.
David Nelson with Nelson Corp Wealth Management. Thanks for your time.
Thank you.
Always
Appreciate
great
it.
advice, and of course we have all this information available for you online at our Quad Cities.